This is Rogers Communications, a telecom up in Canada. This is a long time holding for us. We got in at $54 some years ago, and we have been buying shares all the way down to $30 is our most recent purchase. Right now, the price is hovering right around $28. And I really didn't have any intentions on analyzing this right away, just because we just purchased at 30. But I got into a conversation today about the company and thought I'd come and take a look at it. And I'm glad I did because I did learn some things about the company. So just real quick, I'm gonna go through the earnings call presentation. This is as of January 30, 2025. Just to highlight some good things, maybe some bad things. As you can see here, revenue is up 2%. They reduced their cost to get their adjusted EBITDA up 9%. That's decent. Wireless, as you can see, is a drop. And I think this has a lot to do with the fact that a lot of people are actually leaving Canada. They aren't really attracting anyone up there to live. I know that Canada Film has been doing a lot of work at attracting people to produce TV shows and movies up in Canada. But as far as attracting people to live there, that has really slowed down. I remember years ago, maybe even a decade ago now, that they attracted a lot of persons, specifically from Africa, with certain visas and stuff like that, or I guess I should say easy visas to come and live in Canada. I don't know how that's going, but people are leaving in droves right now, and so I think that's what's driving this decrease. So again, they did add mobile customers just because Rogers is one of the three huge cell phone companies in Canada, and so you kind of don't have a choice. The other thing I want to mention is that back in the day, when you visited Canada from the United States, Rogers was the company that you went to for a prepaid SIM card to put in your phone so that you have phone service in Canada and not have to pay high roaming fees. I used to purchase my SIM card on like Amazon, eBay, or whatever. They would ship it to you, and so when you arrived in Canada, you already have a SIM card. But now U.S. carriers are allowing for free roaming basically in Canada. So I think that is also driving a lot of their sales growth down or declines rather. But the management did do a pretty good job at reducing costs, and so the actual net profit was up a little bit. So that's good. Cable. This is a business that I do not like at all. I wish they completely got away from TV, but for most telecoms, I think that is just what it's going to be. I think AT&T is completely going away from TV now, and yeah, it'd be really nice to see Rogers do that. But for now, it is what it is. So this is actually internet, not necessarily cable, but I think cable is and TV is part of this number. And I'm certain that the internet is what's moving these numbers and not necessarily TV packages. All right, that's it there. One other thing I wanted to mention. So the one thing that I really like about Rogers and what really made the decision to get into this company was the fact that they own sports franchises, right? So Rogers owns all of the Canadian sports teams from football to basketball to hockey and baseball. And they're looking to purchase even more shares of those teams. Back when we first got into this company, Rogers had a very high alpha, meaning that the company performed really well when the market was performing well, and this was relative to its peers, right? Now that has changed over the years, of course, but back then, Rogers was definitely a high flyer, and at the time, I really thought that the sports teams had a lot to do with that. As I'm looking at this here now, this is what has really changed my thought process. So this is the media segment of the company. Okay, And as you can see here in 2024, they received 2,500 in revenue, but spent 2,400 in order to get that. So I mean, they're barely breaking even. And so this is talking about all the sports teams. This is talking about people having concerts and stuff like that. They talked about the Taylor Swift concert up in Toronto at the Rogers Center, but they're spending as much as they're making on this. And then the other thing is you have this capital expenditures, so they're actually losing money. So when you think about the barely profit, now this is $84 million. Still, it's a small profit, but they're spending 263 million. All right, and this is because of a renovation being done at the Rogers Center. Right now, they're talking about purchasing more shares of these stadiums and stuff like that. The other one is in Nova Scotia, right? So same thing, huge hockey arena is where they hold a bunch of concerts and a bunch of events and stuff like that. But the profit margin is so small, and I have a feeling that they're also going to be spending a lot more money on renovating that thing if it has not been renovated in some time. So again, the sports is why I was excited about the company, but as I see now, the sports is not really doing a whole lot. The one thing I did see that I thought was interesting. See if I can find it. Yeah. So this is Sportico. I can't vouch for the valuations here, but this is something I found, right? So they're saying that the sports teams are worth a total of 11 billion, right? And Rogers, the company, is worth roughly 16 billion. Okay. So now, currently, Rogers only owns about 30% of this 11 billion. So we're talking about somewhere in the neighborhood of what 4 billion, right? And they're looking at spending 4 billion to get another 4 billion. Okay, so all in all, they'll have roughly 8 billion, right, in the valuation of these sports teams. But the stock, I don't know if it's going to move on this because it ain't a lot of income that's coming from it, right? Um, so if the stock market capitalization stays where it is, meaning the stock price stays where it is, um, 16 billion, and they have 8 billion. So half of their stock price will be the value of these sports teams. Something is going to have to happen there, right? Either we're going to see a share price improve, um, or um, something has to happen. I don't know what, but a $4 billion asset, um, when you're talking about a quarter of your current market capitalization, means that technically the price ought to raise by 25%. But I don't see that happening. All right. What else? Income. Okay, so let's get into the numbers. All right. Oh, this is what I wanted to do. So, the last time I analyzed this thing was roughly 5 months ago. And so I wanted to double check and see how my predictions held up. Okay. So here on the right side, this is my predicted number, right? And this is the actual number here on the left side. And so as you can see, the income, I was off by about 1,000 plus. The cost of the income, so operations, I was off by 1,000 to the minus side. So same, right? All right, taxes. I was off by about 50. Not huge. This is contractual agreements. I was off by very little. Same thing here, off by very little. This is joint ventures, so not off at all, I'll say. And then the interest looks like I was off right about 200, which I think is sort of a big deal, right? And that's a lot of the reason I think why the share price is going down right now is because of the interest and the debt, the loans, and so forth. So I predicted a net profit of 57.72. I went back and looked at that video, and I was really kind of back and forth on what the net profit is going to be. But the thing is, this company does not move on net profit and earnings, right? But anyway, I predicted 57.72, and the actual number was 63, so much higher. But the stock price continued to move down. Why? Because this company moves on the balance sheet, right? Everything is about the balance sheet. So this is the current annual 2024 numbers. And these are my 1 year predictions, okay? I'm going to slide this over here. All right. So what I'm doing here is a real simple statistic, okay? So we have a standard deviation on either side, so plus minus, right? And then we have an average, okay? So what you're seeing here in the middle is the average for the last 3 years, okay? So on average for the last 3 years, the cash has reduced by 5%, right? And then again, like I said, we also have the choice of the standard deviation. And then I kind of just choose a number based on what I think is going to happen a year from now, right? So don't think the cash is going to move around a whole lot. They do have a deal on the table to receive like $7 billion. Now that $7 billion is going to be used to pay down debt, but they're also, I think, going to have to spend money. They are selling a portion of their cell phone towers, but they're going to maintain control of those cell phone towers. So if they're maintaining control of them, but they're selling them, to me, that sounds like a triple lease net type of deal where the company is going to buy the towers and then Rogers is going to have to lease them or rent them from the new owner. So again, the cash coming in will be good, but the expenses are going to rise. And I think that's a really slick deal because the stock price does not move on the net profit and the earnings, it moves on the balance sheet. So if you're able to get the balance sheet better, then we ought to see a stock price increase. And then maybe they tap the markets to get even more capital in to do some more deals. All right. So what I did to kind of figure this out was I reduced the buildings. Okay, so you see the buildings were 25,000 in 2024, even though on average the number increases by 22%. I decreased it because of the sale of these towers. Right. Okay. The next thing are the intangibles. Okay. Now the intangibles, a lot of it is the actual sports team. Okay, and so we know that they're in a deal to purchase another 30%. And guess what? The average increase on intangibles is 30%. The other side of the intangibles are the agreements they have with the TV stations, as well as all of the licensing they have for bandwidth from the government, because telecom companies have to purchase bandwidth in order to have the cell phone service. So that's a lot of what those intangibles are. But either way, I increased it to show the increase in the sports teams' valuations. Now we know that the sports teams' valuations are only $4 billion, but again, this number is taken as a statistical number here, so it's a possibility that it gets up to that number, right? Okay, so that gives us an actual growth, which is actually on average the assets do grow roughly 17% a year on average. The other thing I wanted to show here is Rogers purchased a company a year or 2 years ago, Shaw Communications, another Canadian telecom. And that is something that Rogers has been doing since 2020. I think we got into this company in 2020 or 2021, maybe, even maybe before 2020. But either way, they have been buying up companies. And so you see this increase in the asset side of the balance sheet, right? And so I think that's going to continue. And so that puts us at 73,000 over the 71 that it is this year. All right. Now, to liabilities. This is what I think is causing the problem in the stock price right now. All right. On average, you see here that the liability side of the balance sheet continues to grow, and it's growing at a higher clip than the assets. So assets are on average 17%, liabilities on average are 22%. Now, the way this works is common sense is if this continues to happen, right, eventually the liabilities are going to be higher than the assets and you have bankruptcy. Okay. So um, that can't remain. Like it has to get better somewhere. Now, I have most of these numbers increased. All right, so accounts payable, that's going to be your salaries and your bills and stuff like that. I have that increasing, even though honestly, they have shown some pretty good discipline in the area of reducing costs. Um, just keep things conservative. I'm going to have that number increasing. And you see here, over the last 3 years, it's increased on average 11%. It did come down though in 2024. Maybe it comes down in 2025, but right now we have an increase. Okay, provisions. Provisions are losses, right? So cell phone companies, a lot of times they will issue credit for people to basically take cell phones for free, and then you pay over time, right? Well, as the economy worsens, um, companies will increase their provisions, meaning that they will estimate how much money they're going to lose on people not paying their bills or not, um, you know, spending on their cell phones. So two things. So cell phone bills, people not paying their bills, but also not paying off the phone that they finance. Right. Okay. So I have that number increasing because again, the Canadian economy and just what's going on up there right now ain't looking great. So I don't have it increasing by a whole lot. On average, it's increased 10% over the last 3 years. So we have that increasing a bit. Okay, contract liabilities. Again, this is uh, whenever you sign a contract, Rogers has to actually provide a service, and that service costs Rogers money. And so they book that as a contract because it's a service they have to provide before they provided it, but they've already been paid. Okay, so it's a liability on the books. We have that increasing if they're going to continue to bring in new customers and sign new contracts. Not only that, but they are offering better deals and lower prices in order to get more customers. And so I think that number is going to continue to increase. All right, leases. Again, I think what's happening with the cell phone towers is that they're going to sell them and then lease them. So I expect the lease liability to go up actually more than this 3,000 here. We'll have to wait and see what happens. We may not see that number change until possibly second or third quarter of 2025. Um, so I think at the end of 2025, this number is going to be much higher than this 3,000. So hopefully I get a chance to come back and take a look at that. All right, debt. So here's the deal with debt, right? So the company they're selling these cell phone towers. They're also talking about selling some data centers. All because they want to reduce their debt. And they have said that purchasing the sports teams, um, and yeah, purchasing the sports teams. They haven't said specifically how they're going to finance that. Um, and so I imagine that they're going to use cash that they're getting from the cell phone tower deal, and maybe even issue new debt to get that done. So what I'm doing is I'm keeping this number the same. Okay, even though on average it increases every year, right? And this goes back to them purchasing all these companies, right? So you can see from 2020 to 2021, the debt stayed the same, right? And then from 2021 to 2022, the debt increased 80%. It almost doubled, right? And then 25% increase again from 2022 to 2023. And that is the issue, I think, right now in the share price. But from 2023 to 2024, it's only a 5% increase. So it's not like, they have taken on a lot of debt to grow. Um, but I think they're trying trying their best to reduce the debt, and hopefully not take on more. But I have a feeling that by the end of 2025, they're going to have taken on more debt. I just have a feeling because as they as they get these sports teams, right? I have a feeling that those sports teams are going to come with more debt. I think they're going to have to end up um, uh, spending more money on revamping one or not both of the arenas that they're bringing on. So again, I'm going to keep it here because I think they are trying their best to reduce the debt, and we know that again they're in this deal to get this 7 billion, even though seven is nothing compared to this 44, right? All right. Taxes. Taxes have increased, and I think it's going to. Now I have it same here, right? But if they're selling assets, they're going to recognize a gain on those assets. They're going to have to pay a tax, but um, I have faith in the management that they're going to um, somehow get away from paying more taxes, just because they have done pretty good over the years. You can see from 2020 to 2021, it's a small increase, and it literally stayed the same until they got into this Shaw deal, right? So I don't think it's going to increase that much. And then the other liabilities, honestly, I didn't look into what those are. I always add them because if they call them other liabilities, just to be conservative, I'm going to call them other liabilities. All right. And here's where we get the magic number, which is the net balance for the company, 10,465. And I'm happy with that number because as you look back, again, this is everything to do with management, right? All of the growing, all of the deals, all of the scandal and stuff that they went through. I've talked about that in previous earnings calls with this company. Um, they have maintained a balance sheet um, pretty stable. It hasn't moved around much at all, much at all. We see that here in 2024 it fell off quite a bit, and again I think that's reflected in the share price. So I think that they end 2025 about where they were in 2023, and so on. If not, if not slightly lower, but I don't think that they're going to come down below this 10, only because the sports teams are going to add something to that balance sheet. All right, so that gives us a book to share price of $19.20. And what that means is that any dollar above 19.20 is going to be premium. So the actual company is worth, what we're saying is $19.20, but a stock is never going to sell for exact. Well, it can, but usually it does not sell for exactly what it's worth. It sells for more because you're buying future profits, right? You're buying future appreciation in those assets. So that gives us a price to book of 1.5, meaning that the share price is about 50% more than what it is actually worth. And so if we look back over the years, we see the lowest price in 2024 was actually 1.59. The highest was 2.57. And then going back, you see 1.86, 2.55, 1.81, 3.23, and so forth. And so what I've been looking at is the growth patterns, right? So we see from 2020 to 2021, when this was a high flying stock, 261, 251, 164, and the lowest was 2.01. That looks like stability, if not a tiny bit of growth, right? 2021 and 2022, we see the low at 1.8, but a high of 3.23. That is definite growth, right? And then in 2023, it's a fall off, but not really historically, right? It's really just back to what it was in 2020, 2021. But what that also means is that there has been no growth in this company for the last 3 years, right? And then when we look forward to 2024, again, 159, 257, again, zero growth since 2020, right? So we're talking about 4 years at this point, no growth. And that is an issue. That is an issue, right? This 159, I think, is the lowest it has been. Yeah, it's the lowest it's been. So it's a new low. And I'm showing if these numbers remain the same, a price to book of 1.47, which means a continual price slide. The only way that we get this number any higher than that. Yeah, is if we have a net balance slide all the way down to 8,000. Now, what that means is that the share price stays where it's at, right? But the balance sheet goes down to 8,000. And that is definitely a possibility. And that means, again, share price does not move. There we go. And so that also means that right now the share price is undervalued, right? So again, looking historically, we're using, oh, well, can't see it. But yeah, so the low, $34, current price is at 28. So again, undervalued. This is based on 177 price to book. Right now, like I said, based on 2025 numbers, we have a price to book of 1.47. This is a prediction. That's why this sale is highlighted. This is not an actual number. This is a predicted number going forward a year. So 177 gives us a stock price of $34. And then we have a price to book at probably two something. Let's see. Yeah, 269. Yeah, 269 gives us a high of 51.72. Now, here's the thing about that $51. Again, going back, looking at the historical price to book, 257, 255, 323. That is a real possibility. Let's look again at moving this balance sheet around. See this? If we have a net balance sheet of 8,000, that puts our max at now $40, which is what the fair value was that I did, like maybe 5, 6 months ago now. So, and then a price to book of 192. It's gonna be interesting to see what happens, right? Um, I do think that the asset side is going to increase. I do think that they're going to do a decent job on keeping the debt low and not adding a bunch more. Um, so what gets us to this 8,000 will be either uh, the assets not improving or them taking on even more debt. Them taking on even more debt. Um, and so if the balance sheet continues to slide, then we can see an absolute high of $40 over 2025, which is still a premium to today's price. Same thing with the low of 32.62, still a premium to today's price. And that was a conversation that was had this morning, which is this thing is way too low. Another thing I wanted to do was take a look at the other um, companies, the other Canadian telecoms, to kind of see what was happening there as well. So take a look at this. We have Bell South, which is the old AT&T, that is now in Canada. Okay, we have Telus, which is another Canadian telecom, and then Rogers. Right. Okay. Just comparing these companies. Look at this. Bell, almost a 17% dividend. Craziness, right? Tullis, almost a 10% dividend. And you see Rogers, 7%. What this tells me is that these companies have lost way more than Rogers. Now, granted, Tullis has always had a high dividend, but even still, the dividend yield tells you a lot because this is what measures risk, right? I'm only going to purchase this company because I'm guaranteed to get this 16%. I'm only going to purchase this company because I'm guaranteed 9%, right? Rogers, much lower yield means risk is usually less. Let's keep going here. Um, the other thing I thought was interesting, net profit, right? Rogers has a much higher net profit than these other guys, right? Return on assets isn't great. Telus wins there. Cash, right? So $1.50 of the actual share price is cash, and we know that they have this deal to bring even more cash on the books. Cash to debt, again, we know that debt is an issue, something that they're working on, but it's still um, better, if not the same, yeah, better than these other three guys. Um, what else? Now, this is the alpha that I talked about. Now, these numbers are based on the previous 3 years, not including this year. Okay. And so we see the alpha for Telus is much better, meaning that the company performs better when the market is performing well. The up move, this is when there is a lot of buying and selling going on, when there's a lot of volume, this company the stock price tends to move up more relative to these other guys. And then the down move is all equal, so nothing to see there. Beta, this is companies that perform well when the market is performing poorly. And we see Rogers wins out there. This is the average 1 month return. Again, this is the last 3 years, not including this year. And Rogers wins there. Volatility, I thought was interesting. Again, this is last 3 years, not current. But Rogers has much higher volatility. Now, when I saw that, that tells me, along with some of the other attributes of the company, of the stock, is that this company, the price is going to jump higher than these other guys, right? But sometimes it means that the price is going to go lower much faster than these other guys. I don't think that's the case. I haven't looked at the price difference. And then, of course, we have our score because we are measuring both the alpha and the up score to tell us what company to purchase in that portfolio. And then the M score, the management score, is much better just because of the cash on books. All right. The other thing that I want to take a look at was purchases. Okay. And I thought this was interesting. So these are funds which are like retirement funds or like 401k, mutual funds, those sorts of things. Mutual funds and retirement funds, they usually purchase shares of companies that are going to have consistent returns so that they can offer consistent returns to their customers. Okay, now that is not always the case, especially in the American market, because a lot of times funds just have a bunch of money that they have to spend and they throw it around kind of wherever. But it's interesting to note relative to these other companies, right? Funds are putting way more money in Telus than they are Rogers, and they're taking money out of Bell. Banks, okay? Now, these are typically institutions that like brokers, right? So, in order for me to purchase shares The broker that I go through has to own those shares, right? So if the broker that I go through doesn't own the shares already, when I purchase those shares in my account, they have to go out and borrow those shares. So it is in the bank's best interest to own those shares so that when I purchase those shares, they can even realize something of a profit, right? Based on what I'm buying it for, based on what they bought it for. But it also means that they don't have to go out and then spend money on borrowing shares, right? Sometimes when you buy or sell a stock, they'll actually have a little note on the screen that'll say this company is currently hard to borrow. So if you do end up having to buy these shares or something like that, we're going to charge you something extra because it's going to be hard for us. We're going to have to spend extra money to go out and borrow this thing, right? So sometimes what that means is that if retail investors, if just regular people are buying a lot of a company, banks will then go out and buy a lot of that company just so they have them in on their books. But there's also too the banks buying these companies to make money, right? So uh, banks are selling or getting rid of Rogers, but they're buying a bunch of Bell South and they're buying a bunch of tellers. Not sure what that means, but I thought that was interesting. Um, the other number here is the percentage of shares owned by funds, right? So you can see that funds own roughly 4% of both Rogers and Bell, but only 3% of Telus. And so maybe that's the reason why they're increasing their shares in Telus because they're trying to get it closer to Rogers and Bell. Who knows? The other number here um, is the again percentage of shares owned by the banks. And as you can see, based on this huge 100% increase, they own a lot more of Telus, and Rogers and Bell is it's very similar. So I think what may be happening here is that people are realizing the profitability and benefits of Telus, and not so much Rogers and Bell, comparatively speaking. So for me, this is still going to be a wait and see. We'll continue to collect the dividend. Um, I really wish we were able to sell some shares on this. Not sell shares, but sell options. Let's do this manually. Um, but I don't see that being the case right now. But it is undervalued, no question. So gonna hold on and see what happens. It may be at this point second, third quarter of 2025 before we see any sort of anything with these new deals and stuff like that. I will continue to monitor the debt as well as the asset side of the balance sheet to see if there is going to be any huge change. At this point, I can't say whether or not I'm going to be looking to get out of this company. Like I said, we last purchased shares at $30, currently at 28. So, I mean, it's been all the way down to 26. Um, if it goes lower than 26, do I purchase more shares? Honestly, I'm not sure. Not sure. It's going to be a wait and see approach. All right, from me to you. I'll holler.